Imagine waking up tomorrow and checking your portfolio only to see that a large portion of your life savings has vanished. Millions of people are on the verge of facing this nightmare right now, and most of them don't even realize it. The stock market, once seen as a path to wealth, has become a minefield. Volatile, unpredictable, and unforgiving. Every day, headlines scream about record highs, crypto booms, and can't miss investment opportunities, luring people into decisions driven by excitement rather than strategy. But behind the flashy numbers lies a harsh reality. Without the right knowledge, discipline, investment, and preparation, you could lose everything you've worked so hard to build. Today, we're going to break down exactly why millions are at risk, what common mistakes put them there, and most importantly, investment, how you can protect yourself and your wealth in this high stakes market. This isn't about fear mongering. It's about seeing the truth and making smarter financial choices before it's too late. Right now, the stock market is more unpredictable than we've seen in decades, and that unpredictability is creating a level of risk that most investors aren't prepared for. One of the biggest factors driving this volatility is the combination of economic uncertainty, geopolitical tensions, and the rapid flow of information in the digital age. Unlike previous generations, today's investors react instantly to news, sometimes before the facts are fully understood. A single tweet, an earnings report, or a sudden policy change can cause massive swings in stock prices within hours. This hyper reactivity makes it extremely difficult to predict short-term market movements and creates a landscape where even seasoned investors can lose significant money overnight. Economic indicators like inflation rates, interest rate decisions by central banks, and unemployment data are constantly influencing investor behavior. For instance, when interest rates rise, borrowing becomes more expensive, slowing down business growth and making stocks less attractive. Conversely, when rates fall, investors flood into equities seeking higher returns, often inflating prices beyond realistic valuations. This constant push and pull contributes to sharp price fluctuations, catching many unprepared investors off guard. Another important factor is the psychology of the average investor. People often chase performance, buying assets after they've already risen, thinking the upward trend will continue indefinitely. This fear of missing out pushes individuals to invest in high-risk stocks, believing they're making savvy decisions when in reality, they're exposing themselves to massive potential losses. The problem is compounded by the proliferation of trading apps that make investing feel instantaneous and effortless. With just a few taps on a phone, someone can pour thousands of dollars into a stock without fully understanding the risks involved. This environment of extreme volatility is especially dangerous for those with concentrated portfolios. Investors who put too much money into a single sector, like technology or cryptocurrencies, are particularly vulnerable. A sudden downturn in that sector can wipe out a significant portion of their net worth in a matter of days. Even large, stable companies are not immune to external shocks, such as supply chain disruptions, regulatory changes, or political events can lead to sudden declines in stock value. Understanding this volatility is not just about tracking numbers or charts. It's about recognizing the real-world consequences for your finances. The market's ups and downs are magnified when individuals fail to prepare for risk, rely too heavily on borrowed money, or ignore the need for diversification. Millions of people are entering the market thinking it's a simple way to grow wealth, but without a clear understanding of these dynamics, the result can be catastrophic. Recognizing the reality of market volatility is the first step in protecting your wealth and making informed, rational investment decisions. One of the most dangerous traps investors fall into is over-leveraging their portfolios, essentially borrowing money to invest, often through margin accounts. At first glance, leverage seems like a shortcut to wealth. If the market goes up, you can amplify your gains significantly. That promise of higher returns tempts many investors, especially when they see others around them making money quickly. But the truth is that leverage cuts both ways. While it can magnify profits, it equally magnifies losses, and in volatile markets, those losses can accumulate faster than anyone anticipates. The danger lies in the fact that when you borrow to invest, you are obligated to pay back that borrowed amount regardless of whether your investments succeed. If the market takes a sudden downturn, your positions may be liquidated automatically by your broker to cover the loan. This is called a margin call, and it often happens at the worst possible moment. Imagine watching your portfolio drop 20 or 30% in a single day only to be forced to sell at a loss to repay borrowed money. Many investors underestimate this risk because the focus is usually on the potential upside, not the downside. Human psychology makes the problem even worse. When markets are rising, overleveraging feels like a winning strategy. Investors see friends or online communities posting quick profits and think, why not me? They ignore the fact that the market does not move in a straight line, and a sudden reversal can wipe out not only gains, but principal investments as well. In addition, some trading platforms exacerbate this behavior by making high leverage options readily available, often presenting them as opportunities rather than risks. The convenience and apparent simplicity hide the enormous potential for catastrophic loss. This risk is not theoretical. History is full of examples where retail investors have been wiped out due to excessive leverage. In moments of economic stress or unexpected market shocks, highly leveraged positions collapse, sometimes leaving investors not only without gains, but in debt they struggle to repay. What makes it worse is that many of these investors are inexperienced, lacking a solid understanding of risk management, stop-loss strategies, or how market swings can compound against them. Leverage is a tool, not a free ride, and using it without strict rules and a risk mitigation strategy is effectively gambling. Millions of people are entering the market with borrowed money, thinking they are making intelligent investments, when in reality they are walking into a financial minefield. The lesson is simple but critical. Understanding the true risk of over-leveraging can prevent devastating losses. By avoiding excessive borrowing and focusing on sustainable, disciplined investing, you protect not just your portfolio, but your financial future as a whole. One of the most overlooked yet critical mistakes investors make is failing to diversify their portfolios. Concentrating all your money in a single stock, sector, or asset type might feel like a smart bet when everything is rising, but it's an incredibly risky strategy. Investment. Diversification isn't just a buzzword. It's a fundamental principle that separates long-term survivors in the market from those who lose everything during a downturn. By spreading your investments across different types of assets, industries, and even countries, you reduce the likelihood that one negative event can decimate your entire portfolio. Many investors are drawn to hot sectors like technology, cryptocurrencies, or trending IPOs. When these areas are performing well, it's easy to feel like you're making genius moves. The problem arises when the market corrects or the bubble bursts. Without diversification, a single sector crash can eliminate a large portion of your net worth almost instantly. Even large investment established companies aren't immune to unexpected setbacks. Supply chain issues, regulatory changes, or sudden shifts in consumer behavior can lead to massive losses, particularly if your portfolio is concentrated in just one or two areas. Diversification is not about chasing maximum returns. It's about minimizing risk. Investment. It's a strategy that allows you to survive the inevitable market corrections and downturns without panic, selling at a loss. A well-diversified portfolio might not deliver the most explosive short-term gains, but it provides stability and security, which are far more valuable in the long run. Investors who ignore this principle often find themselves overexposed to a single sector's volatility investment, and that overexposure can quickly spiral into catastrophic losses. Another dimension of diversification involves asset types. Stocks, bonds, real estate, commodities, and even cash or stable ETFs each behave differently under varying economic conditions. For example, when equities are falling, bonds or gold might hold steady or even rise, offsetting losses elsewhere. Geographic diversification is equally important. Economic cycles, political instability, and policy decisions vary across countries, so investing in multiple regions can protect your portfolio from localized shocks. The danger is that many people view diversification as boring or unnecessary. They chase hype and hot tips, believing that putting all their money into the next big thing is the way to get rich fast. Unfortunately, history shows the opposite. The fastest way to lose everything is to ignore diversification. Spreading your investments across multiple areas isn't a sign of weakness. It's a sign of discipline and foresight. Millions of investors underestimate this principle, and in volatile markets, ignoring it can be fatal. Proper diversification is not just smart investing, it's financial survival. ChatGPT said, perhaps the single biggest reason investors lose everything in the stock market is emotional decision making. Fear and greed are incredibly powerful forces, and they influence almost every financial choice we make. Investment. When markets are soaring, greed takes over. People rush to buy the latest hot stock or crypto coin, convinced they're about to get rich overnight. They ignore fundamentals, valuations, and even the risks involved, because the excitement of potential gains clouds their judgment. Conversely, when markets drop, suddenly fear sets in, panic selling kicks in, and people dump their investments at rock bottom prices, locking in massive losses that could have been avoided with patience and discipline. The problem is that investing is often treated like gambling. Investors check their portfolios obsessively, reacting to every headline, earnings report, or social media post. This short-term mindset creates a cycle of buying high and selling low, the exact opposite of what successful investing requires. Emotional investing turns what should be a long-term strategy into a roller coaster ride, where fortunes are made and lost in days or even hours. Millions of people fall into this trap every year, especially those new to the market or influenced by viral trends and hype. The solution isn't complicated, and everything makes a good investment, but it does require discipline. The first step is have a clear, structured plan for buying and selling, and to stick to it regardless of market noise. This means setting target entry and exit points, using stop losses wisely, and not reacting impulsively to short-term price movements. By removing emotion from the decision-making process, you reduce the risk of catastrophic losses and increase your chances of steady, long-term growth. Another important strategy is education and preparation. Investors who understand market cycles, volatility, and risk management are far less likely to panic during downturns. Knowledge builds confidence, and confidence prevents rash decisions driven by fear. Similarly, keeping a diversified portfolio, managing leverage carefully, and maintaining cash reserves for opportunities or emergencies all help mitigate the destructive effects of emotional investing. Ultimately, emotional investing is not just about individual mistakes. It's a systemic issue that affects millions. The market preys on human psychology, and those who fail to recognize their own tendencies toward fear and greed are often the first to suffer. By remaining rational, investment disciplined, and strategic, you protect not just your portfolio, but your financial future. Emotional control in investing is not optional. It's essential for survival in a market that is as unpredictable and high stakes as today's. Those who master it can weather volatility, make smarter decisions, investment, and avoid the mistakes that leave so many investors financially devastated.